Well, good day, everyone. On behalf of the Asia Society Policy Institute, we're so glad you could join us for what we think is going to be a very interesting and frankly, very timely program. This is another webinar in our series of Coronavirus, Asia, and the World. Over the past couple of months, we've had a number of discussions with prominent guests to discuss the impact of COVID and the economic slowdown in a number of regions of the world, but we've also touched on the response from the international community, including international organizations. And we've discussed the role of the IMF, the role of the WTO, the role of the G20 in the COVID response. And today we're going to round that out with a discussion about what the role of the World Bank is in the COVID response and the economic recovery. Today, with respect to the World Bank, we're going to focus on three kind of buckets of issues. First, the World Bank recently put out its economic forecast for the globe and for the Asian region in particular. They have, like other international organizations, forecasted a slowdown, a negative growth of over 5% in the world for this year. But they also predict that next year we'll see an increase in economic growth surpassing 4%. But of course, a lot of this will be contingent on certain policies being followed, as well as containment of COVID. We'll also, in the second bucket, be looking at what's going on trade in the region, particularly with respect to supply chains and trade flows. And the World Bank has also put out forecasts in this regard as well, which are in line with the more conservative forecast of the World Trade Organization. And finally, we'll be looking at the role of the World Bank, the money it is putting forward, the programs it is targeting in its financial assistance, and in particular, how it is helping developing economies reemerge from COVID and helping them to turn around their economies. And today, we're very fortunate to have with us as our speaker, Aaditya Mattoo, who will help us address these questions. He is the chief economist of the East Asian and Pacific region of the World Bank. And in that role, he specializes in development, trade, and international cooperation, and provides policy advice to governments. And he's also co-director of the World Development Report on Global Value Chains. And with all the attention now being paid on adjustments in supply chains, I think he'll have a lot of important insights to share with us. Before he joined the World Bank, he was also, he served in the WTO Secretariat, where he focused and specialized on services issues. So he brings a lot of expertise to the issue. And now I'm going to turn it over to him. He will share with us some slides and some introductory remarks. After that, I will join in a conversation with him. And we also invite questions from the audience through the chat rooms in Zoom, YouTube, and Facebook. So Aaditya, thank you so much for joining us, and we look forward to hearing from you. Over to you. Thank you.
Thank you, Wendy, for inviting me today. Wendy, can you see my slides?
We can.
And you can hear me?
Absolutely, go for it.
Thank you very much. As you know, Wendy, the developing economies in East Asia and the Pacific were recovering from a period of trade tensions. Then they were struggling with the disease, COVID-19, and the economic disruption that arose from efforts to try and contain the disease. And now they face a global recession. The COVID shock is bringing growth to a halt, and it is increasing poverty. I think we all realize now and that this is an exceptional shock, and it needs an exceptional response in terms of bold national action, deeper international cooperation, and high levels of external assistance. So, for the next few minutes, I'll give you a big picture view of what is happening in the region, how the region is responding, and then, as you suggested, focus a little bit more on what is likely to happen to trade and global value chains. Now, even as the number of COVID cases are increasing in many emerging market economies, East Asia has been relatively successful at containing the disease. If you look at the right panel, you see that the number of cases in East Asia and Pacific are by far the lowest among the emerging markets. Now, there is variation within East Asia. Better prepared countries in the region who had once been bitten by SARS or MERS, ranging from Singapore, Korea, Vietnam, were able to respond early, decisively, and relied on testing, tracking, and targeted isolation and quarantines. These countries were able to contain the disease more effectively and also without resorting to the prolonged, drastic shutdowns that other countries in the region, for example, Philippines, and somewhat half-heartedly Indonesia and other countries are resorting to. And that has made a difference within the region as it has made a difference across the world. Wendy, I'm going to just check again that you can hear me.
Yes, we can hear you.
Excellent. Now, even though the containment of the disease domestically and therefore of the gradual revival of economic activity, at least in some countries in the region, is the good news, the point is that the region is not an island. It is part of a world which is suffering deep economic distress. As some work we've done looking at the global network of production demonstrates that countries with high COVID-19 cases are really the critical nodes in the global trade network, the global production network. As early as March, the 17 countries that were affected accounted for more than 70% of global trade. And it's also true that ever since the mid-1990s, our destinies, our economic destinies across the world have become increasingly intertwined as our production has become more interdependent. As you see, gross domestic product tends to move much more closely. And the reason is the dependence on trade and other flows. Now, the region is particularly exposed to external demand. There are countries like Vietnam which have manufacturing imports as 70% of their GDP and manufacturing exports are 70% of the GDP. But apart from Vietnam, countries like Malaysia, Thailand, Cambodia, all these countries depend heavily on exports of manufactured goods. I need to take a lightning break to deal with a wasp, which has suddenly crept into my life. Anyway, so the key point is that those who do not depend, or apart from the dependence on manufacturing exports, there is a heavy dependence also on services. Now, in the case of a country like Philippines, on a range of back office and business services, but tourism accounts for more than a tenth of GDP for a range of countries from Thailand, Cambodia, Malaysia, and especially the Pacific Islands. And finally, several countries depend on remittances, including the Philippines and the Pacific Islands. So this means that they are super vulnerable to what now happens in the rest of the world. And as we know, trade has plummeted globally and trade has plummeted in the region. Now, financial conditions tightened, and for a moment it seemed as if we'd see the worst capital flight in years, but they have generally stabilized the financial conditions, and the spreads from international levels have not widened as much in the region. If you look at China, Malaysia, Philippines, Indonesia, Vietnam, they're not at all comparable with what is happening in countries like Turkey and Mexico. One source of vulnerability is debt. And there are countries like Mongolia which have large exposure to external debt, to debt denominated in foreign currencies. But even countries like China and Cambodia have large domestic debt and not so much government debt as household and firm debt. And that is a source of serious vulnerability if there is a significant tightening of financial conditions. Now, as a consequence of this domestic shock, global shock, we are seeing what might be the worst shock to GDP growth in decades for developing countries in the East Asia region. You have to go back till the financial crisis in 1998 to see a comparable contraction, and for China you would have to go back to 1976 to see a contraction on the scale that has happened now. Now, despite widespread downgrading of growth rates, so what you have on the vertical axis is the June 2020 forecasts by the World Bank, and on the horizontal axis, you have the January forecast. And this is the negative quadrant, where in a way, if you were to the right of this line, that meant that your January forecasts were positive, sorry, I should say. And if you are below this line, that means your June forecast is negative. And as you can see, large majority of countries in the world, the outlook is really pessimistic. But a few countries in East Asia stand out. And among them are countries like Vietnam and China, who have been relatively successful in containing the disease, but remain unevenly vulnerable to what happens in the rest of the world. Now, that contraction in growth will undermine efforts to reduce poverty. We had expected more than 36 million people to be lifted out of poverty, but now as many as in the bad case scenario, far fewer people will be lifted out of poverty, and it is even possible that as many as 11 million people would be driven into poverty. And even if growth continues and aggregate level, there isn't a dismal contraction in incomes and expenditure and poverty, in specific sectors like tourism, garments, in Thailand, Cambodia, you're going to see people suffer acutely because those sectors are going to see contractions in income far in excess of the average contraction in income. Now, particularly vulnerable are people in the informal sector. I was struck by the fact that even in a country like Indonesia, as many as 3/4 of the urban employed are actually employed in the informal sector. And these people are particularly vulnerable because they're hard to reach. They're not in registries which enable them to quickly receive cash transfers. So some countries like Thailand have made remarkable efforts to deal with it. Now, there are green shoots. China is leading the recovery. This is the purchasing manufacturers index, and you see managers index, and you see that China, but if you're below this line, it means contraction. China incredibly is above the line and showing that there is expansion. In other parts of the region, you see again recovery, but you're still in contraction zone. And Indonesia in particular, you see the outlook is less optimistic at this stage. But even in China, recovery is sluggish and uneven. You see some improvements in industrial production, but retail sales remain sluggish. And in March, GDP contracted significantly. Now, how is the region responding? And now there is a standard toolkit. There's been a heavy macroeconomic stimulus. There has been a relaxation of monetary policy, and three real pillars of this action, which are designed fundamentally to prevent what they hope is a temporary shock from having permanent effects. And that means they're trying very hard to help households smooth consumption so that the loss of jobs and income and the loss of wealth will not lead to terrible distress. Helping firms to avoid bankruptcy so that the loss of revenues and capital will not lead to exit and declines in employment, which are very hard to reverse. And finally, financial institutions are being encouraged to provide support through regulatory forbearance. But again, the concern is that this should not sow the seeds of future financial instability. I have more to say about what the policy response is in a more graduated, textured way, and this is by far the biggest challenge that we face now. And I have dealt with the WASP. I was going to come back. But if you are interested, we can talk more about it later. But now I just want to say that there is a very important role, even though the region has again shown relative, if not absolute resilience. It's really important that the international community provides support, not just to contain the pandemic and mitigate the consequences, but also help with recovery. And here the World Bank Group has responded in the first phase by providing support for strengthening the health system. The second stage to provide relief to mitigate the worst consequences in the way I was describing, and is now also engaged in helping countries think in terms of recovery and what has now become a universal cliche, the notion of building back better. To begin with, the bank rolled out $14 billion of fast-track money, but it is prepared to deploy as much as 160 billion over the next 15 months. Now, let me move to the trade dimension. Wendy, how are we doing for time? Another 5-7 minutes?
Yeah, another 5 minutes on trade would be good, and then we can get into some questions if that works for you.
It does, it does. So, Wendy, you know better than anybody else. It's like carrying coal back to Newcastle to tell you this, but the 2 decades after the 1990s, the period of hyper-globalization where trade expanded, global value chains grew, was also a period of dramatic growth. Poverty virtually disappeared from many countries in the region. But then came the Great Recession and a period of the great flattening. It led to a slowdown. Trade as a share of GDP stopped growing. Global value chains stopped expanding as they were. And so in that scenario, this is the third major shock to trade. I should say, after the recession, of course, the period of trade tensions created this climate of uncertainty, which inhibited both trade and investment. And it's in that context that we are seeing this shock. We see the contraction. The latest figures which came out yesterday from the World Bank show that in April, trade contracted by 1/5. That's 20% contraction in exports and imports. That's huge. But what I'd like to say in the next 5 minutes is that disruption today need not spell contraction tomorrow. I see the COVID-19 shock accelerating 3 trends. First of all, a shift away from China of at least some manufacturing due to what we refer to as dependence aversion. A rapid globalization of certain types of services due to what we think of as digital leveling. And finally, as opposed to these first 2 trends, which are going to create opportunities for countries in the region at different stages of development, we are going to also see an accentuation of protectionist pressures due to the increased inequality, the increased insecurity, and the increased international rivalry. I would love to hear more about what you have to say, but let me just present a few ideas that, of course, to take advantage of the first two opportunities, the countries in the region and globally need to implement deeper domestic reform. But to counter this third threat, we need to think of new imaginative ways of cooperating internationally. One piece of research we did was on the 2011 Tohoku earthquake in Japan. Now, it's a very different shock, but we were curious. What did that shock do to global value chains, to patterns of outsourcing? And it's striking that there wasn't really an increase in imports. There's no sign of reshoring. That even in areas where countries were highly dependent on Japan, after 2011, trade continued and imports continued, global imports continued to grow. What we did see, though, was a switch away from Japan where there was high dependence. In areas of high dependence, importers after 2011 moved away from Japan. Not so much where there was less dependence. Interestingly, no real tendency towards broader diversification, but really switching away towards developing countries and not so much towards industrial countries, but also developing countries which had the right conditions, not towards, for example, India, which had seen remarkable growth. I should have said that this is focusing on automotive components, but we did the same work for electronics and for apparel and other sectors which are GVC intensive. The basic point here is that even though that shock was very different, and we are looking at other shocks, that countries don't retreat because it doesn't make sense to concentrate production at home either, but they tend to switch rather than spread. And today, maximum dependence is on China. And already we see anecdotal and other evidence suggesting that individual firms and sometimes even countries like Japan and the United Kingdom are encouraging switching away from China. Now, already, even before COVID, demographic change in China, increasing real wage in China were inducing a gradual relocation of manufacturing activity to countries like Cambodia and Vietnam. And the first point I'd like to make is that this dependence aversion, which shocks instill, is going to probably accelerate that trend. But in order to take advantage of it, the countries in the region have to implement reforms. Now, a country like Indonesia, for example, has had very little relocation precisely because of its restrictive trade policy and the poor state of its domestic and international logistics. The second big development, which we have already seen ever since the 90s, thanks to the ICT revolution, a growth in services trade. Services which were not tradable, whether it was back office services, IT services, and also a range of professional services, which used to be just produced and transacted domestically, became tradable internationally. And that's what led to a relatively faster growth of services. Now, we had estimated what the border effect is in different services. How much is there a tendency to trade domestically rather than internationally? And it was particularly strong in finance, insurance, and other services, and particularly weak in travel services. Now we are going to see a reversal. That COVID-19 is dealing a terrible blow to travel and in some cases to transport. Now, how durable it is remains to be seen, but it's also encouraging both firms and people to invest in digital equipment and digital literacy. This is common knowledge. What is a slightly subtle point which people haven't quite noticed is that when you were preferring to buy face-to-face domestically, you had very little incentive to trade internationally, whether it was health or education or a range of other services. But once you switch to digital, there is this leveling effect because the relative costs of trading internationally are virtually the same as trading domestically. And that is boosting trade in a range of services which are digitizable. And the other interesting point is that since a lot of these investments that people are making, whether it's in computers and learning, they are sunk, they're here to stay, they won't disappear after the pandemic. Therefore, these effects are likely to be durable. And we see them already in the data. This is data for China's trade and exports of services, and this is January, this is February, and this is March. I just want you to notice quickly that areas like travel, which is this green thing, shrank, but a lot of these other services, finance, business services, telecom, computer and information services are actually growing now. And it's not just in China, but roughly the same pattern in the United States as well. This relative growth of more digitizable services, which we think is here to stay. Now, the first change, the trend that I talked about, which is in manufacturing, will be a boon for countries like Laos, Cambodia, Myanmar, which are now breaking into manufacturing. This second trend, which is a growth in services possibilities and opportunities, will be a boon for countries like Malaysia, Thailand, Philippines, and China, which were looking to move away from the heavy dependence on manufacturing trade and towards greater exports of services. But here, to take advantage of that, they have to improve the quality of domestic skills. And they have to improve even more the quality of the digital infrastructure. There's also a very important regulatory dimension in services, but we can talk about it later. So these two positive trends run against this negative trend. COVID insecurity first prompted export restrictions in medical equipment. We see now a big risk. The risk emerges from asynchronous recovery. East Asia is going to recover before everybody else. That was a blessing when countries wanted imports of masks, of ventilators, of everything. But when East Asia grows faster and other countries are trying to recover, that is when the fact that a lot of this recovery, not just in East Asia, but across the world, was driven by subsidies and state aid. That deadly combination of state-supported asynchronous recovery is going to accentuate pressures for protection. And plus, we are also going to see, as we are already seeing, a certain deepening of divisions between, say, the Chinese and the United States, which were already leading to the tensions, plus the infeasibility of implementing the US-China trade agreement is also going to be a source of stress. Now, in this world, protection could unweave all the benefits that I've talked about of opportunities which are coming in the future. And what can we do? I think we need to deepen traditional cooperation to encompass new measures taken by governments in response to the crisis, from export restrictions to state support. In this same realm, I think the large developing countries have to stop asking for privileged treatment and negotiate as equals, and hopefully we can get a new bargain which makes everyone happy. But I think it's also necessary to cooperate beyond trade to keep trade open in the face of the crisis. Governments are going to emerge facing greater inequality, fewer resources, heavy debt. They'll need to mobilize revenue. Cooperation on taxes, which the OECD was trying to engineer but seems to have fallen apart, is going to be vital to help governments compensate the losers, because that's the only way of keeping trade open. We'll also need to think harder about cooperation on competition policy as large firms take over small firms, and there is a concern about whether this is anti-competitive. And finally, data flows are the flows on which a lot of these opportunities depend, whether it's the reorganization of manufacturing production or of services trade. Here also we need cooperation, wider cooperation along the lines of, say, the privacy shield that the US and the Europeans negotiated, to ensure that we strike the right balance between preserving individual rights but also ensuring free flows of data. Thank you very much, Wendy. That's where I stand today.
Well, thank you so much. There's so much information and such fascinating insights contained in your slides. I'm almost at a loss to know where to begin. But perhaps let's just start with your economic forecasts. And I noted that for 2020, I think the two countries in East Asia that you have predicted positive economic growth for were Vietnam and China. So let's turn to China for a minute. I noticed this morning in the Wall Street Journal, they were a bit optimistic about the second quarter GDP growth in China being in the positive territory. I know for the year 2020, I think you've predicted a 1% growth rate. Can you give us some insight? Is China coming out of COVID and is its economic recovery moving more quickly than you expected? And do you think China can help the rest of East Asia towards economic recovery?
Wendy, those are good questions. As I said, China first saw a precipitous decline in economic activity earlier than other parts of the world, and its first quarter GDP was as much as a negative of 6 or 7%.
6.8%, unprecedented.
It was unprecedented. As I said, you had to go back to the death of Chairman Mao for the last point at which you saw a comparable contraction in China. And this was also a period, the shock was unusual because the purchasing, I always get this wrong, the purchasing managers index, which is a measure of economic activity, whether it's contracting or not, if it's more than 50, that means there's expansion. It fell in manufacturing from over 50 to 34. But what made this crisis different was it fell in services to 29. So services which had historically been resilient also contracted dramatically. Now you see certainly those indices are both in expansionary territory. They're more than 50, and you definitely see recovery of domestic, both industrial activity and to a certain extent services activity. But it's also true that the small medium enterprises are still struggling and they're not completely out of it. Now the question is, has any country definitively contained this disease? No. I think there's a very interesting expression which people use and refer to this as a hammer and a dance, which is that there are periods we'll have to impose very drastic shutdowns, and there are periods where you will be able to resort to more nuanced mechanisms like tracing, testing, and isolation. Now, I think the reason that there is some degree of optimism about China is that it has used the period of the shutdown better than many other countries in the world to create the capacity to contain without inflicting excessive economic pain. And so the first important thing, and that's true of Vietnam as well, that these countries, Vietnam is in fact remarkable. I don't know how many people know that they have not had a single death attributable to COVID. But it's also important to see that there are, you asked me about China and Vietnam, but if I can quickly draw a comparison with a country like Indonesia, one measure of how reliable your statistics on infection is and how effective the state response is, to look at the number of tests that have been carried out as a ratio of the number of actual infections. That ratio in Indonesia is 8, which means 8 times more people have been tested than have infections. In Vietnam, that ratio is 800. And so that's the first reason for optimism, that I think these regions have, at least these countries, Vietnam and China, have contained the disease. Economic activity is reviving domestically, but they are not as I said, islands. Now, the interesting thing is that China's dependence on trade has declined significantly. Imports and exports used to account for more than 40% of GDP. They're much less than 30% now. Therefore, domestic revival is less conditional on what happens in the rest of the world. In Vietnam's case, that is not true. As I said to you, Vietnam is deeply intertwined in global value chains. That 70% of GDP being manufacturing imports, which are semiconductors from Korea, and 70% being manufacturing exports of electronics, suggests that it's vulnerable on both counts. It's vulnerable to disruptions in supplies, and it's vulnerable to contraction in exports. So I do see that Vietnam is vulnerable. The final point you said about can China be an engine of growth? Again, to a certain extent, yes. If you look at the latest April import and export figures, you see, if I'm not making a mistake, that the US growth of exports to China is increasing. And that might be a symptom of that new role that China could play, where it would become a source of a growth pole for the region and the world.
Well, thanks. It could also be an outgrowth of China trying to very hard to live up to its purchasing commitments under the Phase 1 agreement from the US as well. You know, you mentioned Vietnam, and in your presentation, you touched upon a few other ASEAN countries in terms of the challenges that they're facing. And I was wondering, could you talk for just a couple of minutes about, after Vietnam, which countries in ASEAN do you think are best positioned for a quick and full recovery? Is it Singapore? Is it Malaysia?
If I can say one thing before we talk about this, you made an allusion to China's purchasing commitments under the US-China agreement. I think that what China could do, let me stick my neck out, what China should do is, instead of, and what the US as well, all of them, instead of now renegotiating that agreement, which, as you know and I know, is going to be really hard to stick to the precise quantitative limits, China should basically say that it's not going to be about granting the US privileged access to the Chinese market. It's going to be accession 2.0. We are going to use these commitments as a basis for broad-based reform, which we need to do anyway. And we're going to do this on an MFN or non-discriminatory basis, so that there is no, robbing Peter to pay Paul. We won't divert trade away from other countries. And also, it's in our own interest. We need to do this on a non-discriminatory basis so that our firms, our consumers, have access to the best products and services from all over the world. I think that gesture at this stage would also be a really valuable contribution China could make, apart from helping countries with their debt. I think making the debt more transparent and making the terms less burdensome. Everybody has focused on China's exports of masks and ventilators. I think those have been sustained, and China is one country that hasn't imposed export restrictions. And so I think of this as the triad: open up trade, relieve people of debt, and then keep providing and not restricting exports. But coming back to the other countries in the region, I think Singapore, Korea, were among the countries which, apart from Vietnam, were relatively successful in containing the disease. But as you see, they haven't really definitively done that. There are resurgences, especially in Singapore's case. It was very interesting that the resurgence was in a large group of people, which were these immigrants who were living in much more crowded circumstances than everybody else. So it just shows you that even in the most developed countries, there were pockets of vulnerability. Now, the other countries, Malaysia certainly has succeeded much more, as has Thailand, through Thailand's case especially because of deep earlier investments in healthcare capacity. I do feel optimistic about Malaysia in particular. Thailand, you have to remember, was already in a poor, sluggish state. There were floods, there were other issues, a heavy dependence on tourism. I don't think tourism is going to be a return soon. So the more your dependence on tourism, the more I think you are going to be held back. And that's why I'm a little worried, especially about the Pacific Islands. But bottom line is, in the case of Malaysia, I see a revival. Malaysia already, the bank just put out a report, which I would recommend, or is about to put out a report on Malaysia, the transition to high income status. And I hope we can talk more about that. That I do see a cause for optimism. The two mysteries for me in the region right now are Indonesia and the Philippines. These are the big countries about which I don't fully understand because there are countervailing effects. Indonesia, by virtue of being less integrated into global value chains and less dependent on tourism, has suffered that external shock less. And it has also been less stringent in terms of the domestic shutdown. And that's meant that the economic activity hasn't contracted quite as much. But it also means that the containment of the disease is not, it's not clear where it is. So Indonesia is trying to strike a balance between the public health and the economic objectives by restraining the shutdowns, but trying to improve testing capacity. A lot will depend on whether it can succeed.
I thought it was fascinating, kind of the positive spin you put on the impact that the digital world can have on just growth in the region and the world, and how unlike goods, that the digital world can really kind of help everyone. It doesn't discriminate. It doesn't produce as many inequities. At the same time, though, we are seeing countries impose restrictions on digital trade, and we may see more of them, not just in the trade world, but in the tax world specifically, as countries look to raise revenues. So can you, from your perspective, if digitalization is really the key in many respects to economic recovery, what would you recommend governments do or not do in this sector in order to reap the benefits from digitalization going forward in helping it recover, in helping countries grow their economies?
Wendy, I would distinguish between good regulatory reasons for worrying about digital flows and how those concerns are best addressed in a way that doesn't impede flows, and the taxation dimension. I think that when you think of, for example, concerns about security and privacy, I think they're legitimate concerns. And I think the solution is precisely as I mentioned a few minutes ago. It's a kind of bilateral deal. It's something that we've written about, and I'd be happy to make that literature available to you, is the kind of deal that the Privacy Shield made between the US and Europe, where US firms in effect promised to protect the privacy of European citizens to European standards. Now here is an issue where the United States wasn't going to harmonize its privacy law, though there is pressure now to strengthen privacy law in the United States, but that wasn't going to happen, at least in the short term. Also, there was no scope for mutual recognition, as often happens where you say, I recognize your standards, you recognize my standards, let's let our goods and services flow. That wasn't going to happen. So it was an unusual deal. It was an exporter making a commitment to adhere to the standards of the importing country, thinking of the US as an exporter of digital services to the EU as a consumer. I think that kind of deal is the best way of dealing with these concerns, and hopefully also security concerns, that you do need countries to promise, as in a way the United States tried to do in the post-Snowden phase. It tried to reassure the Europeans that there would be some oversight, not just on private abuse of information, but also on state abuse of information. Now that credibility for the state to commit is, I think, a big aspect of the China-US problem. Because it's not just about digital flows, it's also about digital infrastructure. I think that's the other big risk of segmentation. And the challenge here is it possible for the investing country or the country where the infrastructure provider is based to somehow credibly commit to an arm's length business relationship where there's not going to be an abuse of information? I think that is a legitimate concern. And I think if we can think of ways in which we can have that reciprocal deal, that I promise not to interfere, but you promise not to restrict either the flows or the investment. I think that is a question I'd like to hear what you think about. Taxation, I think it's an imperative. The way that we are today, there is no good reason to treat digital flows differently from other flows. In fact, the idea of moving to some notion of destination-based taxation was part of the US proposal, which originally, the irony is, when the big tax reform drafts were coming, there were people like Professor Arbach at California, who was saying that there's very good reason to go towards destination-based taxes. It's as if you have a value-added tax instead of a corporate tax. And the Europeans and everybody else was very upset because, of course, the American proposal was in a way convoluted in a way that might have ended up with some protectionist effect. But in general, in a world where you have profit shifting thanks to dubious transfer pricing, especially in a world where there are so many intangibles, it's very hard to see what true profits in any jurisdiction are. And secondly, there is tax rate competition to try and attract investment so that you have a race to the bottom. One of the pictures I could have shown you but didn't was how dramatically corporate tax rates have fallen in the world, how fast the tax rates of the top 1% have fallen. In that world, I think it is imperative to think of a cooperative approach to taxation across the world. And the beauty of destination-based taxation is that it eliminates incentives to try and manipulate profits. It eliminates incentives to compete on rates. And I think that, especially in a post-COVID world, as I said, inequality is so much greater. Governments will need to show that they can, in a way, adhere to whatever social contract there is and strengthen it by helping losers. If they aren't able to mobilize money, and they're not going to be able to do it, and there's going to be lots of debt. So for that reason, I think we have to think of these two concerns, the privacy or security concern and the revenue concern, as somewhat differently. And it's a pity that the convergence that we were beginning to see in the OECD seems to have fallen apart for the moment.
Well,
but I'd love to know what you think, Wendy.
Well, hopefully for the moment, the OECD talks, they're clearly, at an important juncture, and the US has made it clear that they don't see these negotiations working in a way that is going to provide some kind of equal distribution of revenue. But again, the negotiations have a year-end deadline. Anything can happen between now and then. And it would be quite unfortunate if the negotiations do break down and the United States responds using 301 and potentially imposing tariffs against countries. But I just want to bring it back to what you were saying, because I couldn't agree with you more that digitalization offers a lot of opportunity, and the COVID world has just accelerated our reliance on the digital world. And so I hope that becomes an important force in economic recovery. Perhaps just on supply chains, you had mentioned in your slides that after the Japan shock, that things kind of went back to normal. This time around, however, it feels a little different because governments seem to be getting into the game of providing incentives and, who knows, maybe even penalties for companies to come home, to force them to come home or to encourage them to come home. And I was wondering if you do see this differently and how you think this might play out. And also, if supply chains do move out of China, everyone says that Southeast Asia will be a main beneficiary of those movements, of those shifts, of those adjustments. Do you agree with that?
I think these are all very good questions, and I have a tendency to present things with greater conviction than I should, because we don't really know what's going to happen. And I think, as you said, looking back, it does seem we had expected to see countries perhaps reshoring a little bit. It didn't happen. We had expected even more to see them diversifying. This is looking for resilience. And it wasn't so great, you see, because you can get resilience by saying, I'm going to keep more inventories or keep alternative sources. Somehow that seems to be really costly to do, because it's effect as if in Germany, they have factories or health hospitals which are never used except in dire circumstances. But that means you have to run that capacity, and that's as if you're carrying an unproductive asset in good states of the world, which suddenly has a very high return in bad states of the world. And somehow the private sector calculus doesn't seem to take that into account. What we did see, as I said, is the switching, that you did try and reduce your dependence on a particular source, and that's what we carry over to this shock. That in a way, there isn't a good reason to think China is a less reliable source than any other country. In fact, if it's anything, a more reliable source, because it has recovered so much more quickly. But dependence per se, and that's why I use this term, a dependence aversion, might be a phenomenon where people will move. Now, first question. So that's the firms. What would the firms do? How would they, get resilience? And I think there will be some movement of the kind that I've described. We haven't seen a huge amount, but we will. The second point, what about governments? And here, there's again a good economic argument. Supposing the firm is really myopic. It just worries about short-term profits, not about long-term resilience. Or perhaps it's the firms together, each makes decisions independently, and all of them want to go to China. But from the social point of view, it would make sense for them to spread out a little bit so that we are not overly dependent on one source. Now, those kinds of market failures or coordination failures legitimize governments to say, hey, you are acting in a way that's not in our longer term social interest. And that's a little bit perhaps how you can rationalize the actions that the Japanese and the British government and others have taken. The risk is it's a slippery slope. That once you go down that route, you don't know how much of it is. And remember, a part of that route is to bring production back home. That's completely perverse, because concentrating production at home is not going to deliver insurance. And then some other work we've shown is that countries which are more integrated into value chains have in fact been able to recover faster because they were not entirely dependent on domestic production in general. So I do think that there might be a role for state intervention in principle. In practice, it is a slippery slope, and it could add to uncertainty about policies, about trade policies. It could undermine openness, and especially if it takes the form not of a legitimate diversification, but China bashing or reshoring home. Neither of them is there a good reason for. The final point, where will they go? I think we have seen, and when I'm in Indonesia, they keep saying, why does all the Chinese investors go to Vietnam? And certainly there is heavy movement towards Cambodia. There's movement always also towards Bangladesh and Ethiopia. I think it will depend on the ability of countries to create conditions which are attractive. And here, countries like India and Indonesia are very similar. Each of them continues to restrict imports, aspires to self-sufficiency, and has very poor logistics. In India, for example, it costs twice as much to move things inside the country as it does in even a country like Bangladesh, or 3 times as much as in a country like China. I think those recognition that import restrictions are the surest way of shutting yourself out of global value chains. I think that needs to dawn more broadly. And I think the countries have to think of the kind of business environment. I don't think it's easy to predict where they'll go, but I think it's easy to predict what kind of conditions will attract investors anywhere.
Mhm. Yeah, I agree with you because I think both India and Indonesia are trying hard to attract some of these supply chains that might be moving. But I think when companies look at the business conditions there, they have to weigh many considerations. But the uneven and opaque regulations and the infrastructure, the logistics, um, etc. All those factors become important. I recognize the time, and we're gonna end shortly. I did get one question from the audience, and I'm amiss at this because we did not talk about the World Bank role at all. So, in your final few minutes, can you just give us your sense of how important World Bank assistance is right now towards poverty alleviation, towards helping countries that are struggling with their medical facilities, and what you're doing for households and food and all of that. Is most of the funds you mentioned that the World Bank is setting aside for COVID relief going to developing countries? And is that all over the world, or is one region the focus of more assistance than others?
Just one sentence about Indonesia and India, which I should have said. It's exactly as you said, Wendy, and to recognize that tax cuts, weakening environmental safeguards, and labor standards, those are the soft route to try and attract investment. The hard route is to implement the deeper reforms which make the country more open and stronger infrastructure and resilience. Now, the World Bank. I think, first of all, the World Bank focuses attention where there is need. And those are especially the poorest countries in the world. And those are the countries which get assistance, grants, or assistance at the most concessional terms. As I said to you, the bank acted first with fast-track funding of about $14 billion. I think $6 billion would come from the World Bank and $8 billion from the IFC, which is the part of the World Bank which helps the private sector strengthen. And the first goal was exactly as you said, to try and strengthen health capacity, the capacity to treat and the capacity to contain. Now, if you ask me, we should have worked harder on the capacity to contain, because a lot of expenditure, on treatment, on things like ventilators, is important, but it wasn't terribly clear that it would help to deal with the disease. But investing in these PCR-assay machines, testing, was vital to try and able to test, track, and isolate. So that's the first thing the bank did, and it stepped out and helped a lot of countries. It also is trying to design mechanisms by which the bank procures on behalf of lots of small countries, especially in a world where there is increasing competition for scarce medical goods. So looking ahead,
the bank is procuring PPE and then dispersing that?
Exactly. At least, this is something that I should not step out of my expertise zone. The bank is certainly facilitating the bundling of procurement to reduce the costs and the delivery mechanisms to make them more efficient. I don't know if it actually does that. It probably doesn't do that on behalf of the countries, but plays a facilitating role. But looking ahead, it is also trying to make sure that when a vaccine emerges, that it can be acquired and distributed in a way that poor countries will have access to it. And so I think, and potentially that would also be true of the treatment. And I think that's going to be a big challenge, that even if a vaccine were to come, to make sure that it is distributed equitably. And I think the bank is and has a role to play, as it did in the past in, for example, the meningitis vaccine. There, for example, these interventions which created public-private partnerships helped a lot to improve access. That's step one. Step two is relief. The bank is helping governments to, mitigate the adverse consequences for households, to help firms survive, to help firms retain workers, and finally, also especially to try and get to this elusive poor in the informal sector. That's been a big priority, and both in terms of providing assistance and providing policy and technical assistance. Now, looking ahead, the bank is focusing a lot on helping recovery, and this term that I get drawn into using again and again, which is building back better, which has to do with making sure that you have stronger social protection mechanisms, that you don't have zombie firms, you have firms that are productive and innovative that survive, and also that you look at the environment. You make sure that the new infrastructure or the new firms are using cleaner technologies. I think those are the priorities for the bank. It doesn't discriminate. It doesn't focus excessively on one region rather than another. But our engagement in even somewhat better off countries is really important for our own learning and also for our own engagement and influence in these countries. The final point is the bank is important, but we have to recognize both in terms of finance and knowledge, our relative importance has shrunk. And we need to negotiate a changing world where, the developments that I was talking about in the realm of trade, changing relative dominance, is putting pressure also on the bank, and the bank needs to navigate these changes in a way that ensure that it is durably relevant.
Well, with that, thank you so much. This has been quite a very interesting hour, and I think we could spend more time on any of these subjects. Thank you so much, Aaditya Mattoo, and I would love to have you back. We can reflect more about whether your economic forecast bore out, and also about how effective the World Bank's response is, and whether governments will step up to the plate on trade and cooperate the way you have recommended. I'm not as optimistic on that front, but I couldn't agree more that if there was ever a time when we needed a multilateral response, both to the health emergency and also the economic recovery, now is the time. So your work is very important, and we really appreciate you joining us and taking the time this morning. Thank you very much. And thanks to our audience for joining us. And please check our website for future programs under the series. Thank you. Bye.
Thank you very much, Wendy. It was a pleasure to be here. Thank you.
Thank you. Bye-bye. Bye, everyone.